From New York City for our viewers worldwide, I'm Vonnie Quinn in for Shonali Basak. Bloomberg Real Yield starts right now. Coming up, Fed Chair Powell signaling a policy pivot. His dovish tone sending 10-year yields to 5-month lows and extending the credit rally with spreads at a 22-month low. We begin with a big issue, the Fed igniting the pivot party.
It's a Fed pivot party, and we're all invited.
Obviously, we had a bit of a pivot.
Fed pivot.
The idea that the Fed is done raising rates for now.
We can expect to see rate cuts at some point.
Maybe March may be a little bit premature.
We were very surprised by the dovish tone that Powell struck.
Powell's very dovish comments.
This was the first time that he really gave a nod to the trajectory of inflation and the fact that it is easing.
Declaring somewhat of a victory lap because inflation is moving down towards their target.
What Chair Powell gave us was probably an early Christmas gift.
We got an early holiday present. It felt like Santa Claus came to town a little bit. We've clearly seen the reaction in markets.
Rally in the bond market.
We are in an environment which should be pretty good for the bond market.
We're entering next year, I think, with a growing sense of optimism.
Now, today, John Williams, the New York Fed president, did try to pour some cold water on the pivot or the ebullience, or at least the timing of it. But markets still pricing in cuts next year, and boy, are they. In fact, as you can see, markets pricing in 5.5 cuts right now. The Fed's SEP, remember, prices in 3. So we'll see if one comes to meet the other or what exactly happens. But as you can see, 137 basis points there lower for the US. For the ECB, it's even more pronounced, 160 basis points worth of cuts next year being priced in, even though the ECB was much more underlining of the fact that they have not even started thinking about cutting next year. And as you can see, the Bank of England is going to be joining the party as well, according to traders, 118 basis points of cuts. And you can see the moves in yields of the Fed pivot as well. Obviously, we've been coming down really quite substantially since October 19th, in particular, 100 basis points of coming down. As you can see, this last couple of days, we saw a 30 basis point lowering of the 10-year yield, 2-year yield as well, of course. But Ed Yardeni calls this a mini melt-up. Is that a strong enough reaction? He says it's a mini melt-up in reaction to what's going to be a soft landing next year. But all of this, obviously, is reacting to Fed Chair Powell's comments. Have a listen.
And a question of when will it become appropriate to begin dialing back the amount of policy restraint in place. That begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Joining us now, Marianne Bartels of Sanctuary Wealth and Matt Diczok of Bank of America. Thank you both for joining. Marianne, let me start with you. The most surprising thing about the moves this week?
Well, obviously, Powell surprised everyone. And I think the ones that he surprised the most are the ones that were short the 10-year Treasury yield. And I think that's one of the reasons why you've seen such a dramatic fall in the 10-year yield. We recently did our year ahead in November, and we called it the bucking bull for bonds and stocks. We were looking for bonds to go into a bull market next year. But as you said, the party's already started. And now we're saying that we're running with the bulls in the fixed income market.
Running with the bulls. And let me talk to you, Matt, and ask you if you have the same impression, if this week caught you off guard.
The markets can always cut you off guard. And for us, this is just yet another good example that you just need to leg into assets as they get cheaper. And strategically, we've had the same view for 6 months now. We talked in June. We said, hey, we think the Fed is at or near the end of its rate hike cycle. 10 years moving above 4%. That's close to fair value. Let's start to get slightly long duration here. Rates market went up to 5% on the 10-year. We said the same thing. The Fed is at or near the end of the rate hike cycle. Things look even more attractive. Definitely accelerate getting long duration here. And here we are, the 10-year below 4%. And we're not changing our tune. We think the Fed is at or near the end of its rate hike cycle. Now, the market is totally convinced. 6, 7 cuts coming next year. That is our base case. We think cuts are coming. Our firm forecast is for a soft landing. But at the same time, we're not going to say the Fed's definitely done and inflation's definitely slayed. So we're still cautious as we look to next year, because the history of inflationary spikes is you don't see one, you usually see 2 or 3. So we're sticking to our call at or near the end of the rate hike cycle. generally probably at the end of it. But a lot of juice has been squeezed out of the long duration trade thus far. We've borrowed a lot of those returns from next year, unfortunately.
Well, I do want to ask you about the trade, but I also want to ask you about the gap between what you say is going to be 7 rate cuts next year and the S&P, which is really, even as surprising as it was, is only pricing in 3.
Yes, and so to be clear, we're not saying that. We're looking at market expectations. The market forecast is for 6 or 7. Bank of America believes it's going to be less than that next year. And so, again, there is a very big disconnect here. And obviously, the Fed, I don't think, has expected this reaction. Obviously, we had Williams out today this morning trying to start the walk back a little bit, but the market is taking this and is running with it. And again, so from our perspective, when there's a big disconnect here, we have the rates market saying the Fed's basically done, stick a fork in them, cuts are coming. And credit assets, the credit market risk assets are saying this is going to be great. We have IG now below 100 again, high yield, low 300s. S&P doing quite well, saying, yeah, there's going to be rate cuts, but it's going to be benign, maybe like a soft landing or a mid-cycle slowdown in the mid-90s. So usually those first rate cuts are not usually always market positive. They can be. This doesn't seem like history at all, which tells you when you hike this much, this quickly, again, last 40, 50 years, when you hike more than 325 basis points, you've gotten a recession. When there's that big of a disconnect, our advice for clients is clear. Be fully invested, but neutral across equities and fixed income, up in quality, defensive. Don't take a lot of additional risk. Wait for better opportunities, better valuations for re-risking portfolios.
That's a lot of waiting, Marianne. Are things going to be any clearer come January, February, March? Are we going to get a first cut in March?
I don't think I'd be surprised if you got a cut in March, to be quite honest, because we actually see manufacturing troughing. We're seeing real GDP on a year-to-year basis actually turn up. And, the spending legislation bills that Biden signed really starts impacting the economy next year. That's the Inflation Protection Act, the CHIPS Act, and the Infrastructure Act. And so I don't think the economy goes into a recession. And as Matt said, inflation can ebb and flow. We've actually been comparing this cycle back to the 1950s, where inflation on the CPI year to year peaked around 9% and trended down, and over time actually went negative. I wouldn't be surprised at some point if you do see inflation go negative. But here's what's important. We do think that in the rate cycle, we reached generational lows in 20 and 21. Rate cycles last 20 or 30 years. This rate cycle was 40 years with the peak in 80 and the lows in 20 and 21. We call this a counter trend move in rates. So we think 2024 is a bull market where rates fall. I think one of the surprises could be is if we do have a mild recession, that the 10-year can actually fall to 2.5%. I don't think that's priced in at any point in time. And I think eventually we can actually reach that. But if we were to reach that, I think that is the low, and that we start an uptrend in interest rates again. Therefore, we're really stressing with clients that they want to ladder portfolios, because we do think interest rates over the next 3 to 5 years are going to trend higher. And you would want your bond portfolio to be maturing so you can lock in those higher rates.
So, Matt, Marianne is calling for 2.5% on the 10-year, which is a phenomenal move from here. But we have seen phenomenal moves quite quickly, right? Earlier, we caught up with BMO's Earl Davis, who explained his favorite trade, and it's another interesting one. Have a listen.
We just shorted U.S. two-year bonds, discounting 165 basis points of eases by January, 150 by December. It's plausible, but we like that tailwind of being short. You actually make money if nothing happens. So we think that's a great tactical trade. A great structural trade is buying real yields and tips on pullbacks.
So explain to us the thesis here, Matt, if you would. I mean, would you be shorting real yields at this point?
We certainly wouldn't be shorting real yields. Again, our investment time horizon is longer than that. But we've been using real yields as a barometer of market cheapness and a time to, again, extend duration. And a couple of months ago, when the 10-year was about 5%, we had real rates across the entire tips curve at over 2.5% or 2.5% or higher. We thought that was a remarkable opportunity. If we were talking 2 years ago, you're getting negative 2% real yields. For the privilege of owning government securities, you can lose 2% of your real wealth per year. So we like real yields right now around that 2% level, not as much as we did a couple of months ago, but we find these to be attractive valuations. Fixed income is finally diversifying portfolios again with higher yields, both nominal and real, and the ability, as Marianne was laying out, to potentially drop significantly if we do get that a recession. So I got to be honest with you, it's a good time to be a bond guy for now. People talking to me for about the first time in 10 years and wanting to listen to us. So we feel fairly good about real yields right now, although not as great as we did when they were higher a couple months ago.
You know, Marianne, we did have John Williams coming out and I don't want to say throwing fully cold water on the idea that they've been talking about how to cut, but he did, you know, suggest that it wasn't the big discussion that the market sort of took it to be. Do we need to hear from more Fed speakers in relation to this in order for the market to walk back a cut by March or, you know, more than a 25 basis point cut even?
Well, I'm not surprised that they're trying to walk it back because the market itself had a dramatic move on its own expecting rates. And then Powell just added fuel to the fire. I think between now and year end, it's going to be very hard to dial things back. We're only a few trading days away from closing the year. And I think portfolio managers are window dressing and really trying to lock in those returns. By next week, a lot of people are going to start going on holiday. So you would have to have more commentary next year. But I think all eyes next week will be on the PCE. We do get the PCE. If that does surprise much above expectations, I do think you get a knee-jerk reaction within both the equity market and the interest rate market, but I think it's temporary.
Yeah, Matt, I mean, the market sort of ignored the Empire Manufacturing Index today. If there is some kind of a surprise with PCE next week, does the market take notice?
I think the market will take notice. And I think what you saw from the Fed today with Williams' comments, I think the Fed is probably a little uncomfortable with how certain the market is of, again, the market saying 6 to 7 rate cuts, the market saying a rate cut definitely coming in March at this point. So I think it's moved a little bit far, a little bit fast for the Fed's comfort. But the Fed has changed its messaging fairly dramatically. A couple of meetings ago, we were higher for longer. Last meeting, we weren't talking about rate cuts at all, and now it's part of the conversation already. So it's very difficult to micromanage markets. Fed policymakers are determined, good, hardworking people trying to do their best, but this is very difficult to try and micromanage market. And so they have made the pivot, and now it seems like they feel the market might have gotten ahead of itself. We need to see this play out a bit, but again, this disconnect between what has usually happened with history and what the market is saying is going to happen now means, again, for the portfolio construction and asset allocation aspect, just being defensive up in quality, staying close to home while being fully invested and taking advantage of higher yields probably makes the most sense right now.
Well, it's interesting as you both speak. Reuters is coming out with a headline from the Fed's Bostic, Raphael Bostic, seeing 2 rate cuts in 2024, likely from the third quarter. So I think that's a second voice really trying to change the market's mind a little bit on what it heard from the Fed chair this week. Marianne Bartels and Matt Diczok, thank you. Up next, the auction block. High-grade issuance meeting the usual December chill. Plus, credit's reaction to the pivot. We got all that next. This is Real Yield on Bloomberg. I'm Vonnie Quinn in for Shonali Basak. This is Bloomberg Real Yield. Time now for the auction block, where there was definitely a December chill felt in the USIG issuance. Despite a strong backdrop for borrowers, today sees another day with no companies looking to sell bonds. The week was front-loaded and saw volume come in just below $2.5 billion worth. The slowdown might indicate a wrap for the month. That would leave supply at nearly $23 billion, well short of the $30 to $35 billion forecast. And a different story over in high yield. Bond sales now stand at $12 billion worth this month. For context, that's more than 5 times what we saw in December last year. JP Morgan's Oksana Aronov warning of a credit reckoning.
typically, when we think about a higher rate cycle and who that impacts most dramatically, of course, it is the lower rated credit operators that are hit hardest. And today, we have a credit market overall that is the most lower credit quality skewed ever, with 80+% of it BBB and below rated. I think the credit reckoning may take its time to arrive, but it will arrive with some really dramatic repricings.
Let's bring in Craig Bergstrom of Corbin Capital Partners and Brian Rehling of Wells Fargo. So issuance, it's a little bit of a head scratcher. Let me come to you first, Brian, and ask you if what we're seeing is based on any kind of reality out there in the markets.
Well, I don't think so. I think you'll see issuance pick up next year. I mean, we've had just a really dramatic drop in rates, and it takes time, I think, for things to move through the pipeline a bit. But, no doubt with the decline in rates that we've seen, credit spreads, as has been mentioned, quite tight. I think issuers will be a little bit more proactive in the new year once we get past some of the lockup periods.
Craig, explain to us the tightness of these spreads at the moment.
We think that generally, credit markets have obviously rallied very strongly. It feels like generally they're following other risk assets, right? It's following a rate move. It's following very strong returns for equity, mirrors strong returns for on-the-run leverage loans. But at the same time, it doesn't feel to us as investors like those on-the-run credit assets represent particularly attractive value right now.
Yeah, and explain to me why the market is being so kind to junk borrowers, let's say. It feels like there's absolutely no anticipation that there will be any kind of trouble ahead.
I guess if you want to look on the bullish side, you say, hey, market is expecting 3-4 more rate cuts next year. If you get that and a soft landing and very supportive equity environment, a fair amount of dry powder in private equity and private credit, I guess you could get there. But that, again, in our mind, doesn't necessarily make for a particularly attractive risk reward for those on-the-run credit assets.
Well, that's the other part of the story, right? Brian, are markets pricing in unachievably perfect outcomes next year? And is an investor getting rewarded for taking that kind of risk?
Well, I mean, you could say the same about all risk markets, really. They're kind of priced for perfection here. I think they'll continue to perform well up until that kind of perfection soft landing scenario is proven otherwise. I don't think it's a great risk reward in especially high yield credit. However, the carry is hard to ignore. So until we have that event, until you have kind of the sell-off, perhaps a day of reckoning, you're just going to underperform if you don't own high yield, at least up to your benchmark. So that's the struggle.
Craig, I want to get your thoughts on when we are going to see a first rate cut, given that we also now have Bostic coming out saying he sees, 2 next year starting from the third quarter, which would seem to just, put a little bit of...
Yeah. I mean, the market's pricing in a cut as of March, at least, recently. We're not in the rate prognostication business, right? That's a tough business even for the people who do it all the time. So we don't manage our portfolios to super granular rate views. But it seems like there's room to get disappointed there.
Yes.
Right? Especially when you sort of think about it from an institutional perspective at the Fed. Hey, to cut in March and be wrong on inflation, to have it, remain a little bit more persistent, seems to me to be far more institutionally damaging than to wait another quarter.
So are you saying that the Fed must be fairly convinced that we have inflation licked?
I think, I would put it differently, which is we would say that, certainly reasonable likelihood of cuts next year, but I think that, we think it's a reasonable bet to say they might be fewer and later than the rates markets are pricing in today.
So in other words, you're agreeing with what the Federal Reserve officials are saying right now. Brian, would you have the same reaction?
I would, given kind of the current environment. I view the tails next year as probably greater risks than kind of the consensus, which is the kind of the soft landing 3 or 4 rate cuts. I think either there's the potential that something breaks, we've remained tight for too long and the Fed has to get fairly aggressive cutting rates, or I would probably lean a little bit more towards kind of the tale that perhaps the punch bowl continues. Consumers continue to spend. You don't see the uptick in unemployment that some might be expecting, and you actually start to see inflation reaccelerate as we get into the second half of the year, and perhaps the Fed actually has to start hiking rates again. I think it's really difficult to handicap those scenarios, but I think they have to be on the table.
Craig, you think the CLO market is going to face significant challenges. So where are you looking for opportunities? I know private credit is an area that you're very interested in as well.
So the CLO market is interesting, right? You haven't seen a ton of issuance this year. We actually think that the debt side remains pretty interesting, right? So, you talk about high yield and sort of needing to participate, and obviously to the extent people are managing to a benchmark, that's a real issue. But CLO AAAs yielding around 7 we think are really interesting now. We're more active down in stack, but I think for an individual investor looking for a low risk option in a retirement account, for example, a AAA, AA 7 I think is really interesting from a risk reward perspective. I think that in the CLO market more broadly, we haven't seen a ton of issuance, and it's picking up a little bit, but we think that that it's going to remain a somewhat challenging environment, given how wide liabilities are and what that means for CLO equity returns.
And Brian, very, very briefly, are you seeing any opportunities outside of the United States, given that we're going to see a bunch of central banks, start to cut and pivot next year?
Yeah, we're really focusing more on the U.S. right now. The U.S. is just in a much better position than the rest of the world. The economies elsewhere in the world just aren't doing as well as we are here. So I don't see a huge advantage in terms of moving, overweighting outside of the U.S. right now.
All right, we got to leave it there, but thanks to both of you. That is Craig Bergstrom with me here in studio and Brian Rehling. Still ahead, the final spread, the week ahead. Another key inflation print. This is Real Yield on Bloomberg.